Hi, welcome to our video series here from Burkholder Wealth Management. My name is Jordan Bradford, and I'm here with our CEO and founder, Eric Burkholder. And we're here to give you a little bit of a market update here as of about September 6th.
Yeah,
So we're going to talk a little bit about what's been going on in the economy
right.
and how that has translated to market performance here roughly, two-thirds way through the year.
Right. Yeah, and I would say there's kind of been, three big headlines. I'd say for most of the year
Mm-hmm.
that kind of stay consistent, which are inflation continues to cool, although it's higher than what the Fed and the government want. We've had a pretty resilient bull market,
Yeah.
despite what people were saying at the beginning of the year. And then GDP numbers have continued to kind of surprise on the up end. Now there's some mixed signals in there, which we can talk about, but still, resilient bull market, resilient economy, and inflation looking better. So all in all, I would say it's been some positive trends, which then that ultimately is reflected in asset prices and kind of what we've seen in the market.
Yeah, yeah. Well, let's talk a little bit about
Okay,
inflation. So we don't have the August numbers yet,
right.
although as soon as we get those out, we're going to make a post on what that is, and who knows, by the time you see this video, those numbers might be out, but we will send that out when we have available.
Yeah, absolutely.
But let's talk a little bit about July's inflation and then kind of where that leads to
Yeah,
us
so the
next.
most recent numbers we have now are July. So those were about 3.2%
Mhm.
annualized rate from the previous year, which was it's still slightly higher than the Fed's long-term target of 2%, which seems a long, long ways off
Yeah.
at this point. But even now we've seen some predictions for August being somewhere in the mid threes again.
Hmm.
So um, it's a glasses half full, I think, reading compared to what we were a year ago.
Yeah.
It's much better, but it's still, as I said, higher than what the Fed would like us to be at. So what that means is there's still potential talk of another interest rate increase, potentially again before the end of the year. And there are fairly there's a lot of debate and criticism over what is the right path from here.
Yeah.
Obviously, we're seeing the strain in the housing market with high interest rates and mortgages, and so the Fed's got a tough job ahead of them. I will say
Mhm.
the outcomes so far have seemed to go pretty well. We can debate whether that we should give all that credit to the Fed or not, but what is happening in the economy and things has gone well, but I
Mhm.
would say it's on a razor's edge from going from, hey, this is pretty good to no one's buying houses anymore
Right.
and some major problems. So, we're optimists here. Things are going okay, but we'll see where it goes.
Yeah, I think it just shows the Fed is walking a tightrope
Yeah.
to an extent, right? We're trying to get inflation down, but we have to balance unemployment, which is ticked up a little bit
Yeah.
from prior months and years. Still very low, but a little bit higher tick up in unemployment. Housing market seems to be slowing down a bit, so I think the Fed is going to have a lot of decisions to make here at their next meeting as to whether or not to continue with their rate increases or to pause them again like they did just a couple of months ago.
Right. Yeah, and even with unemployment, it's very hard to read the tea leaves because uh, we've we had a lot of people re-enter the labor market
Mm-hmm.
last month, so that naturally will cause the unemployment rate to go up because now
Right.
more people are looking. So is
Mm-hmm.
that a good thing? Is it a bad thing? And so
Yeah.
you know, I think the market, and I'll kick it to you for some market numbers, but I think the market is interpreting these things mostly as positive, especially at the beginning of the
Mm-hmm.
year. We had several clients calling and asking, like, it seems like a recession's for sure going to happen. Should we get
Yeah.
out of the market? Which I want to emphasize, we do not time the market here. Just
Mm-hmm.
case in point, like it is very hard to predict, but coming off the beginning of the year when things looked very dire, and now, what has the market done since then?
Yeah, well, August was overall not a great month for the market. Pretty much all the major indexes were down. The Dow led the way, actually, it was down about 2.6 for the whole month of August. But everything was basically down across the board. We did get a bit of a reprieve in the last week of August, though. The market really bounced back pretty considerably in that last week. Still down for the month, but regained a lot of the losses over the first 3.5 weeks roughly of August. But year to date, if we're looking at the numbers, right, I think we all have to be pretty pleased with the market returns compared to what we were looking at just 12 months ago or even 9 months ago at the beginning of the year. So we've got the Dow right now year to date up about 5.1%. The S&P is up about 17.6%. And we have the NASDAQ cruising along up 34.1% year to date. Mm-hmm. So I think that's another, it's a kind of a fun example though, because the NASDAQ is now up more this year than it was down last year. And yet it hasn't hit that break even point yet.
Yeah.
So if you've seen a lot of our videos before, you know why that is because when you ride the wave down, digging yourself back out of that hole becomes much more difficult. A 33% decline requires a 50% rate of return to get back to even. So, anyone who is just looking at, year-to-date numbers on the NASDAQ might think, well, clearly that's the place to invest. And we're not saying that you should be absolutely all into the NASDAQ or all out of the NASDAQ. But I think it's really important to have context to what those returns mean. And when the NASDAQ was down about 33% for the entire year of 2022, this great return this year is awesome and incredible, especially if you held out and decided not to cash out at the end of last year. However, you're still requiring about a 16% rate of return between now and the end of the year if you want to break even by December 31st.
Yeah. And we talk a lot about behavior and even just from a behavioral standpoint, it's so difficult to ride that wave.
It is.
And what you often see happen is, now your money's getting back closer to even. You've had great performance. And so, last year you thought, I'm never doing this again. I really shouldn't have been so growthy. And then you get sucked back into saying like, well, I'm going to ride it out a little more. Right. And then you just go right back over the next cliff. And that's just, it's so difficult and it's emotionally exhausting. And that's why we really, promote having an investment plan you can stick with long term.
Yeah, diversification is key. You don't want to be beholden to any one sector because this roller coaster ride that the NASDAQ is on, hopefully it doesn't last for 10 years, but it could. I mean, if you think about the performance of how poorly it performed last year and how great it's performed so far this year, there's a lot to be said about the potential that we may not be seeing the high point of the NASDAQ yet, but it's also possible that we have this year.
Right.
And that means that if you're holding a like a QQQ fund as an example, and that's a big position, you might be starting to think, well, gosh, 34% return in a year. Is it time for me to get out? And you're not even at the highs yet.
Right.
In fact, you're pretty far off still. So I think diversification so important. We promote it regularly here, but there's a reason why you want to be diversified, right? There's a broad spectrum of investment returns, and just looking at the three major indexes, you can see that between the Dow, the S&P, and the NASDAQ. And so to be highly concentrated in any one of those areas is going to be adding to the risk of your portfolio, and it's not improving the overall results.
Right, and I think you hit the nail on the head with diversification. I think it's important to note that clients are participating in part of that.
Yeah.
They're just not betting their entire retirement on it. Exactly. And actually, what that enables you to do is years like last year when the tech and growth got smashed, is you actually had something to put into that. All right, we had value-based investments that could go into the growth part of the market. Right. And then this year, now when it's rebounded, we're not like, oh, we're so far off of even, we don't want to sell. No, actually, we bought in last year. It has now done really well this year, so we can actually trim, and it feels good to be trimming now that it seems to potentially getting overvalued again. So when you own some of everything in the right proportions, it actually gives you more opportunity to manage risk and buy and sell at attractive prices.
Absolutely. Yeah, I think that's the key to the story here is just stay diversified. The market is outperformed expectations so far this year. I think that's fair to say.
Yeah.
But we don't know what the next 3 months of the year are going to hold. We don't know what the next 6 months, 12 months. We have an election coming up next year, so we know that that always brings extra volatility and uncertainty in the market. And I think just staying true to a core portfolio philosophy that aligns really well with your long-term goals, that still remains the best chances of you to be really successful.
Right, exactly. And so, but as always, we are keeping track of what's going on in the economy and markets, and want to give you guys the boilerplate notes so you can also be informed. But yeah, at the end of the day, your personal plan is what's going to drive your success. So we're happy to answer any questions on the economy or investments or your portfolio. So just let us know, and we're happy to get with you.